Hello everyone. This is a video about drawn liquidity. In previous video, we talked about bias. So when we say bias, that was our way of defining the direction, which direction the price wants to go. So now, if we want to define drawn liquidity, so our drawn liquidity is basically the targets or the areas where we look for the bias, right? So in short terms, you can say drawn liquidity is the places where price wants to head towards or where price wants to reverse from. So when we talk about drawn liquidity, in simple terms, it is defined as internal range liquidity or external range liquidity, which is nothing but when you say external range liquidity is nothing but the swing highs and swing lows, or the previous candle high and previous candle lows. So basically, the swing highs or swing lows and high and lows are external range liquidity, and the fair value gaps are internal range liquidity. So what does this mean? This means when you are talking about drawn liquidity, we are basically talking about the swing highs and swing lows, right? So our aim is to find out which point or which area is to be expected to be hit first before price reverses, right? So when we talked about bias in previous video, we said we have three conditions. One is reversal, one is continuation, and third one is accumulation or the choppy market, right? So once price reaches some kind of drawn liquidity, it hits some drawn liquidity, we expect price to reverse from there, right? And when the price has taken some drawn liquidity and it has reversed, then we expect price to make continuation move towards the next drawn liquidity. So bias gave us the direction and drawn liquidity gave us the areas to target, right? So how market functions in two ways, right? It is either seeking liquidity or it is offering fair value. So what do we mean by seeking liquidity? Seeking liquidity means nothing but the price wants to take the swing highs or swing lows, right? Or swing lows or previous candle lows. So when price wants to target the swing highs or swing lows, we say it is seeking liquidity. Why seeking liquidity? Because there are so many stop losses above or below swing high and swing lows. Because when price turns around, what happens? Someone must have sold it here. That's why price went down. So when someone sold it here, he must have put their stop losses somewhere around here or somewhat higher to this swing, right? So in this area, we have a lot of liquidity resting. So when price wants to take out this swing high, it is actually targeting that stop loss, right? So we are saying this is it seeks liquidity. And when price takes the liquidity in a very violent move, what happens? It comes back to fill that gap, right? So when price comes to fill this gap, we say it is offering the fair value, right? So price moves for only these two regions, right? So now, suppose in this case, if we say our external range liquidity is what? Our swing highs and swing lows and previous candle high, previous candle low, right? So here, this is our external range liquidity. This is our external range liquidity, right? So price moves from here. It takes out this external range liquidity. It goes up high. In historical move, there must be some PDRA, something should be there. So price takes turn from there and it comes and it targets what? The fair value gap. It is offering the fair value. Once the price comes here, then what happens from here? The price turns around and now it is targeting the external range liquidity. Now one confusion that we have most of the time is when we talk about internal to external move, oftentimes we think it only goes from internal to external or external to internal, right? But that is not the case. Sometimes it goes from external to external and sometimes from internal to internal, because it is possible. Suppose we are in this case, suppose we consider this as swing low and this is swing high, right? So this is also external and this is also external, right? So we don't have any internal move here, right? So in lower time frames, what happened? It went here, it took turn from there at lower time frame, it took this liquidity which was external, and after this external it is going again for the external. So it is like going from external to external. And sometimes what happens, in one impulsive lag we have multiple fair value gaps, right? So on lower time frames, when it goes from external to internal, sometimes for the higher time frame it is what? Internal to internal. So it goes high, takes rejection from the upper fair value gap, comes back down, takes support from the lower fair value gap, and then it goes high, right? So on lower time frame it appears like external to internal, but for the higher time frame, if we look, it appears like it is going from internal to internal and then from that internal to external, right? So drawn liquidity is not giving you the direction. It is only giving us the indication of what are the possible places where we can look for the reversals, right? So now this thing we already covered. Seeks liquidity means it wants to target the old highs and old lows, and fair value means it wants to rebalance the gaps that were left behind the price, right? So it means it wants to fill the fair value gaps, right? Now suppose this is the example for the monthly time frame for Nasdaq. So if we look at this move, the price was going down, down, down. It hits some sort of PDRA or some sort of liquidity here, external liquidity. It If we look at this swing high to this swing low, from here we are targeting what? Once it took this swing low, we are targeting what? Internal range liquidity, which is this fair value gaps. It comes, it doesn't go down. It comes here and then it goes, takes out this high, right? Takes out this high, right? When it takes out this high, it makes what? If fair value gap goes up, it takes out this high, right? So for this whole thing, this is what? A swing high, right? So it takes an external. After taking this external, it comes back to this internal, right? Now, what did I tell you? That it can go from internal to internal as well. Now, when we were looking at this thing, this impulsive lag, this was what? External and this was what? Internal. But now look at this one, from this swing to this swing, right? After taking this external, what is this price? What is the price respecting to this gap, right? So this gap is internal for this leg, right? So basically we don't have to look it like it will go from internal to external, external to internal. We will have to look it like it goes from one drawn liquidity to another drawn liquidity, because our drawn liquidity is external or internal. It depends on which leg we are referring to, right? So now how price moves? Price moves from external range to internal range and internal range to external range, right? So in this case, suppose this is the first case, it takes out the external range high, it goes somewhere here, it price turns, it comes down to internal range. So when price moves in this direction, which is against the higher time frame direction, like the retracement move, what is this forming? From this point to this point, it forms a lower time frame sell model, right? Market maker sell model forms here. Similarly, in case of buying, it comes down here, it hits the internal range, and when it goes up, it makes a lower time frame buy model, right? And same thing for the sell cases, right? For the bearish moves. Now, what confusion we have? All of us are more or so aware about the internal to external move, external to internal move. But the problem appears when we take the external move. Most of the people, what they do, like when they come across this concept, as soon as this price is taken, they will start. I'm talking about the CRT guys. They start taking out the reversal trades or the retracement trades right from here, right? Once price closes above this, okay, this has taken the external. Now it will go to internal. So every CRT they will take. If it is coming around 159, they will immediately start shorting it, right? But that is not the right way, right? Because what we have to look into, this was the bullish move, it took out the high. So if we are trading this down move, it is nothing but a retracement, right? It's against the trend, right? So that's why what they say, when you are trading from internal to external, it is somewhat easier to trade than trading from external to internal. So suppose this is the weekly move, right? So in weekly move, once the weekly price has been taken out, weekly swing high is taken out, what do? We go for the intermediate time frame, which is for the weekly. We have 4 hours, right? So after this swing high has been taken, we will look for what? A SMT on 4 hours with the correlated assets. So when the price turns, more often it makes a SMT, right? So it creates an SMT above this high. Then we know, yes, price wants to reverse on the lower time frame here. So once this SMT is formed, then we can take our short trades to what point? To the internal range liquidity. So the one mistake that we do is when we are trading any chart, we only open that pair and we simply look internal to external, external to internal. No, that is not the right way. What we have to do is, whenever we are trading, we need to put the correlated asset as well, right? Because what happens, sometimes you will see the price will go to external, it will drop down to internal, but when it go to target external, it is unable to reach that one, right? And then we'll say we were targeting this external, but it did not reach, and then it reverses and it takes out our stop loss. So in that case, what happens? This price did not reach external on this asset, but its correlated asset reached the external. So a SMT was created there. That's why it did not hit your target, but it reverses from that SMT and it took out the stop loss, right? So whenever we are analyzing any pair, we need to make sure that we have a correlated asset as well, so we can look at the both charts at the same time, right? That is the basic idea of quarterly theory as well, right? Whenever we are analyzing any chart, we always look at the correlated assets, right? So now, what is the our map, like how what are some key points that we need to look once some of the liquidity external or internal is hit, right? So when external is hit, we look for the SMT on the relevant time frame. Like it could be SMT, it could be SSMT, it could be PSP with displacement, right? These are the concepts from the quarterly theory. I'm sure you must have been aware about these. If you are not, I'll try to make some videos in future, but for now you can just look on YouTube for the videos about these concepts, so you have some idea of these, right? So SMT, SSMT I did cover in the previous bias video as well, so you can check from there. So suppose the price hit the external range liquidity, right? But we don't see any SMT, right? So what you will do, if we don't see an SMT, what you will do, we will look for a impulsive lag to form on the lower time frame, right? What is impulsive lag? Impulsive lag is we have a swing high or swing low, price moves, price creates a fair value gap, right? So when price creates a fair value gap after a swing, that becomes our impulsive lag. What does it mean? It means when the swing was created, price reversed, and then when the fair value gap was created, that means price displaced in that direction, right? So then it becomes a high probability lag, right? So whenever we are trading, we are always looking for an impulsive lag to trade from, right? So when external liquidity is hit, we look for SMT. If we are not able to find SMT, we will stop there. We will wait for a market structure shift with an impulsive lag, right? So we are not looking for any market structure shift which does not have a fair value gap, right? We need a fair value gap for sure, right? Now, once that fair value gap is formed and price retraces back to that fair value gap, now we can again look for our SMT or SSMT or whatever quarterly theory concepts we can use there to trade in direction of that leg, right? And whenever internal range liquidity is hit, we will look what? In that internal range liquidity or that fair value gap, we will look for the SSMT, SMT or PSP, right? Any of them will work. So if suppose we have 4-hour fair value gap and our price is coming into 4 hour, what we will drop down to 15 minutes, right? And on 15 minutes, we will look for a SSMT or SMT between the correlated assets. Once we have the SMT between the correlated pairs, which indicates that now we want to reverse from here. So that gives us an extra confluence, right? If we don't have SMT, then what we will do? We will wait for price to create a market structure shift there with an impulsive lag, right? Or inversion of the fair value gap from the previous leg. Right? Once we have that one, we have our impulsive lag. Now what we will do? We will drop down to a lower time frame. We will look again from internal range liquidity to external range liquidity. What does that mean? Suppose we have a 4-hour which was coming to a 4-hour fair value gap, right? What we will do? We will drop down to 15 minutes. We look for 15 minutes. Either 15 minutes creates an SMT, that is first case. Once we have 15-minute SSMT or SMT, we look for the impulsive lag, we trade from the fair value gap directly, right? If we don't have SSMT or SMT there, we wait for 15 minutes to come. We wait for 15 minutes to create a market structure shift. We wait for that impulsive lag to form. After that, when the price comes to the 15-minute fair value gap, we drop down to 1 minute, and in 1 minute we will look for our SMT or SSMT. So basically the idea is we will not trade unless we have the confluence of SMT, right? Now, so when we say we are looking for the drawn liquidity or direction to trade, so we will only choose the pairs which have an impulsive lag, right? So what is impulsive lag? This is one swing low, this is possible swing high, right? And this whole lag has one fair value gap, right? So this is our impulse lag. And what was the idea? The idea was to wait for price to come, hit any of these liquidity, create an SMT there or SSMT there, and then trade from that SMT, correct? So in this case, this is Euro New Zealand and GBP New Zealand, which are correlated assets, right, on daily time frame. This was an impulsive lag, this was an impulsive lag, right? look at this point. On this day, when the price came down to the internal range liquidity, at the same time, if you see, we don't have the price hitting this low on GBP New Zealand, right? So the price thinks into daily fair value gap, which is our internal range liquidity, or our fair value gap, which is our point of interest. We look for our reversal around these points, right? So once price hits this one, we look for what? SMT or SSMT? Now see, this day took out the low of previous day, right? But here it fails to do so, right? So what do we have? We already have a weekly cycle SSMT, or we can say we have an SMT with the previous day, right? So we have the SMT. Now we can drop down to our lower time frame and we look for the 1 hour entry, because this was daily. So our daily SSMT is confirmed on 1 hour, right? So once our daily SSMT is confirmed and we have our 1 hour order block in place, we can trade based on that order block in bullish direction. So now after hitting this point, we have SMT. So now our direction is clear. This was our internal to external we want to go. So our drawn liquidity is confirmed. This is our drawn liquidity, this high and this high. First thing. Now second thing, based on bias, this took the low of this one, this fails to take. So we confirmed SMT on 1 hour. So now our bias is bullish, right? So now what we will do, we will target this drawn liquidity, right? But suppose this price came here, it does not create any SMT and it doesn't give any lower time frame signatures to go up. So what will happen? This price will close below this fair value gap. In that case, what will happen? Now we are not targeting this drawn liquidity, right? Now what we are doing, if this price did not reverse from here, where can it reverse from? This fair value gap, right? Or this fair value gap, right? So we wait for the price to hit those areas, right? Once this price hits those areas, until then we can trade lower if we want to trade on low time frames, or we can wait for these areas to be hit. Once the price hits here, we will see if there is SMT confirmations. If there is, then we can trade in this direction. If not, and price closes below this fair value gap also. Now when price drops from here and closes below this, we do have a lower we do have a bearish impulsive leg formed, right? So we will have some kind of bearish fair value gap here also. In that case, when price reaches to that fair value gap, and if we find any SMT there, we can target this low, right? Because if the price did not go up from this fair value gap and close below this, our next drawn liquidity becomes what? This one or this one, right? So our drawn liquidity is just the areas that we are looking to target or we are looking to reverse from, right? It is not the direction, it is the areas where we look for the bias, right? So once price closes below this, we will target this one. If it gives us a bullish signatures here, our bias turns bullish here, we will target this one. Now this is the same chart when this price hits this area. This is on 5 minutes, right? So it comes down here. This one was, I guess, 1 hour chart. So once price closes above this one, we have 1 hour order block confirmed. Now once this is confirmed, we are looking for lower time frame signatures to go long, right? Because now we have what? We have our SMT confirmed and we want to go long, right? So once price comes into this one, what do we have? We have this low was taken by this one, but this low was not taken by this one. This is what? A kind of SMT, right? So once price closes above this one, at this area, we can trade long. So that is the idea, right? So these are some markups that I did for the possible entries. If you want to enter, we can enter from this area. We can enter from when the price goes below this, or we can enter when price closes above this, because it is also creating again the bullish SMT, right? So once we have our drawn liquidity and bias, we can take trades based on the SMT on lower time frames as well, right? This one is our recent example of Euro USD and GBP USD. If you see, once price hits this swing high, this was swing high here. Once price goes above this swing high, it goes up. Somewhere there was a high time frame PDRA. This high was taken by this candle. This high was not taken by this candle. So we do have what? A bearish SMT here or SSMT here for the weekly cycle. And once that SSMT was confirmed, what happened? The price reversed to what? This was external, right? This previous candle high was what? External range liquidity. Price takes out this one. After that, price reverses to what? The internal range, right? Internal range, price takes internal range. Price hits internal range here on GBP USD, fails to do so here. So now what do we have? We have again SMT here. So now price will target what? The previous candle high and then the swing high, right? So that was our idea about the drawn liquidity. Now, if we go, how do we use the drawn liquidity? So see, when we are using the drawn liquidity, our aim is to look for only the impulsive legs, right? So we are not focusing on what was happening on this side, right? Suppose we want to target on these days, we are only looking for the recent swing high to swing low, right? Which have a fair value gap. If we don't have any such swing, what we call it? We call it swing. We call it impulsive lag, right? Impulsive lag is what? A swing high and swing low with a fair value gap in between, right? So if we don't have any such swing present, what we will do? We will either move to the higher time frame to find such a impulsive lag, and if we want to trade, like for sure we want to trade, we are not able to wait, then we can move to lower time frames, but then it becomes very messy at lower time frames, because then you will have to switch your drawn liquidity multiple times, because those are not very high probability. So I don't prefer to go below daily or 4 hour, not below 4 hours. So in that case, what you can do is you can analyze multiple pairs, right? On some pair you will definitely find these kind of impulsive lags. So it becomes easier when you have clear impulsive lag. So then what you can do is you can wait for the price to hit the fair value gap, go to the respective time frame, look for your SMT that we talked in the bias video. If we get our confirmation for the bias in our direction, from there we can look for look to target the drawn liquidity, right? Suppose it came here, it gave us the bullish divergence here, bullish SMT here. We are targeting this high here. Now what happens? At this place, we'll get our reversal signatures, right? Now, after we confirm that reversal, now it moves high. Now from this place to this place, from this point to hitting this external liquidity, we can look for the continuation signatures that we talked in the bias video, right? Now, another thing is, if we are suppose waiting for external range to internal range move, right? So we need to be like sure that we have an SMT present, because what happens, mostly people do take trades without any SMT, right? So this SMT should be your like a confluence for each trade. Because if you are not taking it with SMT, then the probability of winning the trade becomes very less, right? Because if it was that easy, like price will go from this swing high to again fair value gap and then fair value gap to again swing high, if that it was that much easy, everyone will do it, right? Because we all know from internal to external move, right? Like most of us, we come here, we have already watched these kind of videos before, that price goes from internal to external, external to internal. And in our discussion group also we talk about this a lot, that price is targeting the internal now and external now. So what is the signature that we need to see that price is ready to move to internal or price is ready to move to external? That signature comes from the quarterly theory or the SMT, right? So that was like it for the DOL video. I think I covered most of the stuff. And one more thing, like if you have the habit of watching only one pair, just make sure that whenever you are, like suppose you are trading euro, USD or gold, whatever, just make sure that the chart of correlated asset is always there with that analysis, because it will clear out many things. Because most of the times when we are targeting the external liquidity and we fail our setup, it is because the correlated asset has already hit that target, right? And we miss that SMT point there, and that's why it does not work, right? So that was it from the dual video. I tried to cover most of the things that I use, but if there is any confusions on this one, please feel free to message me on the discussion group. And uh, sorry for the delay in the video, because last time someone complained that there was so much background noise, so I had to get new microphone and took some time to deliver. So I'm recording it at night time now. I'll publish it right now, and if you have any further questions, just feel free to message me. And what next video you want, just ping me or drop comments below the video. And if you have not subscribed the channel, please subscribe. And thank you very much, guys.